Good morning, it's me, Kenny Polcari, your host of the party, and today is Wednesday, August 16th, 2023. And what is it that you need to know today? Well, yesterday, who remembers Batman from the 1960s, right? Pow, bam, bang, ouch. If you do, then you'll know what I mean. Neely Kashkari, Minneapolis Fed president, calls for more regulation, and guess what? Higher rates because inflation is still too damn high. Financials and banks get smashed on the back of that news. Retail sales are up, but so are prices. And Asia continues to come under pressure as China circles the drain, or at least that's what they tell us it's doing, so if you believe anything that comes out of China. And what do we have for dinner today? We're going to try the Mussels Trieste-style, which are delish. Okay, so investors got punched in the face, right? Kicked in the gut on Tuesday. Stocks declined as concern about the state of the global economy hit home, sending the algos into a tizzy, right? You toss in some negative comments from Minneapolis Fed President Neely Kashkari about the need for more regulation around regional banks and the implied threat then by Fitch to downgrade some of the country's biggest banks, and you have a recipe for disaster. The eco data was about the consumer and retail sales, and those numbers were quite strong, or at least on the face of it, they look strong, right? As if the consumer is alive and well, but we'll get to that. Retail sales month over month are up 1% versus the expected 0.4%. Ex-autos and gas also up 1% versus the expected 0.4%. But listen, let's be honest. All that tells you is that the consumer is spending more to buy less. That's what the increases in retail sales means, right? So don't kid yourself. Remember, prices are still going up. They're not coming down, and that's the issue. And then we had the state of manufacturing in New York. It plummeted by 19 points versus the expected down 1, right? So it was a big miss in Empire Manufacturing. As the day wore on, the stock sank further and further into the abyss as the sell momentum just gained steam. By 4 o'clock, the Dow was down 361 points, or 1.1%. The S&P lost 51 points, or 1.2%. The Nasdaq gave up 160 points, 1.2%. The Russell lost 24 points, or 1.3%, while the transports gave back 285 points, down 1.8%. So let's break it down, right? The global economy, you know what this is, right? We talked about it in yesterday's note. It's China, it's Russia, it's Argentina, it's Europe, it's the UK, it's the US. It's about global interest rates and the path forward. It's about the seasonality, right? The August-September timeframe, which is usually a weak time of year. It's about the recent FOMO rally that has taken stocks up strongly, maybe too strongly, since June 1st, right? When we saw the tech rally start to broaden out to the broader market as asset managers and retail traders who had stepped out of the market decided that it was time that they needed to get back in because they were missing out, right? Taking the SMIDs, industrials, basic materials, healthcare, energy, financials, all these sectors higher, right, as we moved away from tech, leaving some investors now feeling like they got had. The minute they jump in, the tone changes and the market turns south, which is exactly why when you trade your investment account, you usually end up losing as you try to pick tops and then you pick bottoms. You go in, you go out, you go in again, you go out again, you go in again, right? When you invest in your investment account, you design a portfolio that represents you, your risk profile, your age, your time and grade, your needs. You pick names, you pick entry points, you create the ongoing plan that includes dollar cost averaging and dividend reinvestments, and then you just stick to it, period, the end. Right? And then we had the former Goldman Sachs vice president, the former assistant treasury secretary under Hanky Paulson during the great financial crisis, and the current president of the Minneapolis Fed, Neely Kashkari. He came out to say that he favors more regulation around regional banks, saying that he doesn't think the current proposals that set higher capital requirements for banks with more than $100 billion in assets goes far enough. He cites the Silicon Valley Bank crisis earlier this year. What he failed to say, though, that it was the regulators that failed in their duty to protect not only the bank depositors, but the system as well. So now he wants even more regulation, as if the regulators played no role in the Silicon Valley Bank demise. I mean, come on, really? And then, as if no one was listening, he slipped in the fact that he also thinks inflation is still too damn high, suggesting that there's at least one or more rate hikes on the table. Then again, as you know, Fitch raised its head again, threatening to downgrade some of the country's biggest banks due to the industry's health. Now, what's interesting is that Fitch did downgrade the score for the industry back in June. They took it down to AA-. And this went unnoticed because guess what? It did not trigger a downgrade on individual banks. But now they're threatening to downgrade the score from AA- to A+, right? See how they did that? It went from AA to single A. That's how that works. That's actually a downgrade. And if that happens, they're saying, then they would have to recalibrate the financial measures, which would translate into a negative ratings actions in the group. Now, both of those headlines caused the whole sector to move lower. The XLF fell by 1.8%, while the regionals, the KRE, fell by a whopping 3.3%. This directly tied to the Kashkari comments, and this puts a new round of pressure on the names in the group. So proceed with caution. Some of the names are solid, but the headline will put pressure, causing some investors to bail. Note what happened. Western Alliance down 4%. New York Community Bank down 3.3%. Regions Financial down 2.7%. Zions down 4.5%. And all of these, and all this means is that if you're sniffing around, just sit tight. There's no need to chase these names at all. Let them come to you. Every time Neely opens his mouth, the wave of selling just washes over the marketplace. And then we had the eco data. Did you see that? Did you see how they want you to kind of consume it? Retail sales came in well above the expectation of 0.4%, right? In fact, it came in 0.6 better, right? Ringing the bell at a full 1% increase, right? The media trying to tell us that the consumer is strong and that the consumer keeps spending, so there's nothing to worry about. Okay, let's discuss this, right? Retail sales tracks consumer demand for finished goods by measuring the purchases of durable goods, right? Cars, stoves, dishwashers, and the like, and non-durable goods, things like food, fuel, clothing, shoes, cosmetics, cleaning products, etc. Both sectors have seen big increases in prices. So it makes sense that that you spend more, causing retail sales to increase. Even if you buy less, it's all semantics, capiche? So be careful how you interpret the retail sales. And speaking of retail sales, it's a big earnings week for the retailers. Yesterday we heard from Home Depot. And yes, they beat the number. They came in at $4.65 a share versus the expected $4.46. And yes, they announced a $15 billion stock buyback program. And yes, they admit that sales are sliding down, not up. As consumers do what? They pull back, especially on the big ticket items. Although they did reaffirm their full year outlook. In the end, the stock traded up 2.5% in the early morning, only to trade down by 0.5%, so 3% swing before settling in up 0.6%. Today we're going to get Target and TJ Maxx before the opening bell. What will they reveal about the health of the consumer? Look, Target already announced and they beat. But they beat earnings, but they missed on revenue. They lowered their full year guidance, but margins are up. And traders are taking it up 4% in the pre-market. But remember, the stock is down 23% since June, right? On a sell the rumor, buy the news type of mood, as well as they also had that whole pride issue in June where customers fled the stores and all that stuff. So that caused kind of the move lower in Target. All of the 11 sectors in the S&P were lower yesterday. Energy was down the most, 2%. Financials down 1.8. Utilities down 1.6. Think higher rates. Basic materials down 1.6. Consumer discretionary down 1.4. Tech, communications, and healthcare all down a little bit less than 1%. The contra trades were the clear winners, right? The DOG, the SH, and the PSQ all up better than 1%. The VIX, which is the fear index, shot up by 11%, and that sent the VIXY, VIXY, that fear ETF, up 5.5%. This morning, trading in Asia is still mixed, right? Overnight, last night, trading in Asia. From Tokyo to Taiwan, from Shanghai to Sydney, the message is get out of the way or risk getting run over, as China reports that its home price index is now the latest data point that's in contraction territory. And all that means is more negative Chinese data. And I, for one, actually couldn't be happier because I don't play in China, right? Remember, China is a communist country. They don't play by the rules, and so you can't really believe anything they say. Now, Japan, on the other hand, they do play by the rules. They reported improving business conditions, but no one seemed to care. Japan, Hong Kong, Australia, and South Korea all lower by more than 1.5%. China lost 0.7%, and Taiwan was actually flat. European markets this morning are churning. They're not really up, but they're not really down. They're just churning as investors in the UK grapple with higher inflation numbers, which means they can expect the Bank of England to do what? To continue to raise rates. CPI in the UK rose by 6.8% versus the expected 6.7% increase, right? It remains 3 times greater than their target, which is 2%, the same as us. And it was the 5th time in 6 months that the CPI surprised to the upside. In addition, the markets are awaiting the second pass at second quarter GDP along with the UK home prices. U.S. futures are up small this morning, and this makes some sense after the beating they took yesterday. At 6:30, the Dow futures are up 7, the S&P's up 1, the Nasdaq up 12, the Russell's up 1. Eco data today includes mortgage apps, housing starts expected to be up 1.1%, building permits expected to be up 1.5%. Industrial production and capacity utilization come out at 9:15. At 2 o'clock, we're going to get the July FOMC minutes. Don't expect to hear anything new. The Fed has left the door wide open to pause or to hike. And that's not going to change today. They're going to leave themselves all kinds of wiggle room, right? The dollar index is down just small, but it's settled in at 103.06, which is closer to the highs and closer to the trendline resistance. Oil has moved off its most recent high on the back of all this negative China news, even as supplies are tightening. Yesterday it was down 1.7% to close the day at $81, and this morning it's trading right there at 81. The chart suggests that it should find support right here. But if they continue to highlight a weaker China, then expect more downside pressure until they get it to where they want. And then suddenly the whole China story is going to change, right? It'll go from negative to positive, and the downward pressure will stop, demand will surge, and oil will resume its upward trend. Gold is holding steady at 1937. The S&P ended the day yesterday at 44.37, right down 51 points. But futures this morning are suggesting a lack of direction, right? Which means, in my mind, the path of least resistance is likely lower versus higher at the moment. And that means take your time, do not rush, do not chase, and don't be emotional. My sense is that the trend is still lower and will remain so throughout the next 5 or 6 weeks, like I told you, until we go into September. We get the PCE inflation report, we get the next CPI and PPI. Oh, and you can reach out to me. I'm always happy to discuss and engage. Okay, so what do we have for dinner tonight? We're going to have the mussels, and this recipe comes to us from Trieste, right? So it's called Mussels Trieste-style. Now, Trieste is a seaport in the northeastern part of Italy on the Gulf of Trieste, right? It's way at the top. It borders the Adriatic on one side and the country of Slovenia to the north. The history and culture have been impacted by Austrian, Hungarian, German, and Latin influences. It is the capital of one of the 20 regions in Italy called Friuli Venezia Giulia. At one point, it was the 4th largest city of the Austro-Hungarian Empire and was known for its contributions to literature and music. After World War I and the collapse of the Austro-Hungarian Empire, Trieste partnered up with Italy, and today is the capital of one of the richest regions in that country. So mussels prepared Trieste-style are easy to make and even easier to eat. You just need the mussels, so you need like 2 dozen mussels, thoroughly washed of any sand. You need white wine, you know me, Pinot Grigio, Santa Margherita. You need clam juice, garlic, sliced onion, olive oil, salt and pepper, fresh bay leaves, and toasted Italian seasoned breadcrumbs. Now, in a pot, you're going to heat the olive oil, you're going to saute the garlic, you're going to add the onions, continue to saute them, don't burn them. Now add in like 1.5 cups of the dry white wine of your choice, nothing fruity, you know me. You want to stir it, let it come to a boil so the alcohol burns away. Then you're going to add a bottle of clam juice, a couple of fresh bay leaves, season it with salt and pepper, turn the heat down to simmer. Now add the mussels to the pot and cover it so that it steams and the mussels open, right? Cook until the shells open. Maybe can't be more than 5 to 8 minutes. Tossing those so the shells, kind of in the juice. Discard any mussel that doesn't open. Now add a couple of handfuls of seasoned Italian breadcrumbs and toss well so that the breadcrumbs mix with the wine and the juice to create a thickened sauce. You don't want to add too much breadcrumbs, but maybe more than a handful. It depends on the quantity of mussels, and it also depends on the quantity of the sauce, right? So you kind of have to judge that. Again, you want to set the outdoor table with placemats, nice linen napkins, and the wine glasses. Hopefully there's a full moon to help set the mood. Present this dish in a large bowl with the mussels bathing in the sauce. The dish demands toasted garlic bread to dip in the sauce while you are feasting on the mussels. Serve this with, again, your favorite chilled white wine. For me, it's a Pinot Grigio Santa Margherita, but there are others that prefer like a Falanghina maybe with this recipe. I, though, will never stray from my Pinot Grigio Santa Margherita. In any event, it's a hump day here in Florida, as it is really around the world. You can see the weather's nice. It's kind of a sunny day out there. The sky is blue. Not a whole lot going on, so maybe that portends for what's going to happen today in the markets. Maybe the markets will come down. Maybe they won't. We're about to find out. Until tomorrow, take good care.